I, of course, don't see gold or silver as a bubble at all. I see debt and fiat as the bubble that's in a process of deflation. The Bank of America calling gold and silver bubblish, the Kospi, but quite comfortable with US equities at the current levels. Our primary macro view is more upside for gold. So people will say, but hold on a minute, Francis, we had this big ass sell-off, we were at 5,600 and then bang, we got this rejection. And of course, it closed lower as well. It was a red candle. I mean, we all speculate on how much gold China truly has. But I can tell you all black gold that is being subsistence mined ends up via Saudi, UAE into Hong Kong and Shanghai. As someone who's living in Africa, there's a permanent bid on that and the refining process and taking it. They've set about using gold as a trade-based vaulting system for their trade system. So they're going to establish vaults for counterbalancing. Millions have been stripped out. There was a lot going on in terms of government hires. Look what's happening here on the gold-silver ratio. I, of course, don't see gold or silver as a bubble at all. I see debt and fiat as the bubble that's in a process of deflation. I know you want to touch on the Dixie and the dollar, so I won't steal too much thunder until you're ready. But yeah, as an opening statement, that's what we're sniping and that's what we're observing. Bank of America calling gold and silver bubblish and the Kospi, but quite comfortable with US equities at the current level. So there you have
it. Yeah, that sounds very backwards. So let's start off with gold and silver. Could you pull up the charts and let's look at gold, where we're at. We had a big blow off top back in January, the end of January. I'm sure folks are wondering, okay, did we top? Are we leveling out, building the base again? So just curious in what you're seeing on the charts.
Yes, good question, by the way. And I think the charts are the place to get the answer for that as well.
When banks call metals a bubble but defend expensive equities, something doesn't add up. As Francis Hunt notes, labeling gold speculative, while the S&P trades near historically elevated forward PE levels above 21, raises credibility questions. Bank of America's positioning reflects how financial institutions benefit from equity market stability, while debt levels exceed $34 trillion in the US alone. The January blow-off move in gold looks dramatic on charts, but compared to liquidity expansion since 2020, metals have barely kept pace with monetary growth. As Francis Hunt implies next, the charts may contradict the bubble narrative entirely.
So I'll start a share. Just before I do, I want to highlight that people should remember there's a macro. There's a difference between leverage trading short-term and investing for the macro. And so time frames, you behave differently on leverage. A lot of other things apply. But if we just go to the investment point hypothesis in gold, our primary macro view is more upside for gold. So people will say, but hold on a minute, Francis, we had this big ass sell-off, we were at 5,600 and then bang, we got this rejection. And of course, it closed lower as well. It was a red candle. It was one of the first in a while. And at one point, you're as low as that. So technical analysis, macro technical analysis is our forte. It's one of our unique USPs. That would be typically called a shooting star. And it is a bearish candle on a weekly time frame. So let me just clarify. We're looking at gold. We're on the dollar. We're on the weekly time frame. And that qualified as a shooting star.
Short-term fear often distracts investors from long-term trends already in motion. As Francis Hunt explains, leverage trading reacts to weekly candles, while macro investing follows liquidity cycles that unfold over years. A weekly shooting star reversal can signal caution, but it doesn't automatically invalidate a broader bull trend, especially when central banks continue accumulating gold reserves, which rose over 1,000 tons globally in recent annual data. Investors who confuse technical pullbacks with structural reversals often exit positions prematurely and miss recoveries. As Francis Hunt will show next, candle patterns only matter when confirmed by follow-through.
Now, there's only one way you negate a real shooting star, and that's where you deliver the exact corollary to the same degree of volatility candle. So what is the corollary or the countervailing force of a shooting star? Well, it allows for the ongoing downside initially. So you closed here, you opened here, and you traded immensely down on that wick. So that is still the impact of the shooting star. However, if you're to negate it, what you need is a similar scaled reversal. So here was the upside reversal, and there is your downside reversal. Go past your open and close the week higher up on the week with a green body. So what you've actually got here, and we called this after 2 days. Many people saying, but how can you say that on the weekly candle? The weekly candle wasn't even finished yet. And our goal is to be early. You can't say anything about the future with any great confidence, but our expectation, given the volatility and the rebound, at that time,
Technical reversals matter less than the conviction behind them. As Francis Hunt highlights, negating a bearish candle requires equally strong buying pressure, something institutions typically provide during accumulation phases. Market history shows that failed breakdowns often trigger stronger rallies, particularly in commodities during inflationary cycles like 2009 to 2011. When volatility expands but price stabilizes, it usually signals absorption of selling pressure rather than trend exhaustion. Investors watching weekly closes instead of daily noise can better distinguish between correction and reversal. As Francis Hunt suggests next, confirmation comes from how the following week behaves.
this was a slightly red candle, and it was roughly here, but it had a big hammering wick on it that already highlighted quite a high element of rejection up to here. In the end, at the end of the week, it had gone all the way up to there. So we turned out lucky or accurate for forecasting that. And it is a negation of the volatility reversal to the upside to have an equal, similar, and proportionate volatile rejection of the lows to a similar degree. So the new week, which has just started here, and it's this little abandoned baby over here that's tiny because we've only 2.5 days in. I know you guys on the US side are only waking up, so to you it'll be 2 days. We expected reflation. So we are post slap in the face events of volatility. We have been in the camp for quite a while now. 2 days into the previous week, we were already saying our suspicion is this is going to be reflation, and that was validated by the weekly close. And what have you seen? You're seeing a green candle mildly up on the big time frames. So that's the big time frames. I've actually said quite a lot. So before I drill down any lower, I'll just hand back to you.
Markets rarely reward certainty. They reward patience during uncertainty. As Francis Hunt points out, the rejection of lows followed by a green weekly candle suggests buyers stepped in faster than expected, reinforcing the reflation narrative. This matters because commodity bull cycles often resume after volatility shocks, not during calm periods, a pattern seen repeatedly since the 1970s inflation era. While media attention focuses on daily price swings, longer time frame candles show whether institutions are accumulating or exiting positions. Investors watching weekly momentum instead of headlines gain a strategic advantage.
So I'm curious in your perspective
And
there too.
further to which I would highlight the debasement of oil, that when we first called short oil, long gold, it was $87, having been as high as 129. It's now at 69. I think, my apologies, not even 69, but it looks like it might target 69 if that break up to the upside occurs. So maybe call it even 70. The costs for miners have actually gone down during this period as their top line has blown up to the upside. So you are talking about a cash hemorrhaging corporations here, and they look absolutely fantastic. And you asked about the gold-silver ratio, and it's a great question, Daryl, so I want to take you back straight into the weeds of that and say, you remember what I was showing you in the gold chart with the shooting star that had the intra-week reversal. It had a body like that was red, and it had that huge wick that did that. And how I said the only way you negate the bearishness of that is you have a squaring up and an equally strong reversal to the downside like this.
Falling input costs during rising commodity prices can supercharge mining profitability. Francis Hunt is pointing to expanding operating leverage in mining companies. revenue rising, while extraction costs stabilize or fall. Historically, gold miner margins expanded sharply between 2009 and 2011 under similar price dynamics. When oil declines, mining energy costs drop, boosting free cash flow across the sector. Francis Hunt is connecting commodity interdependence. Energy prices quietly influence mining equity performance more than most investors realize. Next, the gold-silver ratio chart begins signaling potential metal market rotation.
So silver, I want to touch on silver and copper. So recently, a friend of mine had texted me because we were talking about the $12 billion stockpile of critical minerals, and obviously silver, copper being two of those. And then he texted me an article and shows that China invested $500 billion in their power generation and things of that nature. And so he was like, yeah, this makes this little 12 billion look like peanuts. And so just curious your take on that. And then also, what is silver telling us? Obviously, it's a monetary metal. We have this government stockpile dynamic as well as industry and such. And so just curious on your perspective there.
Yes, so China generally has been far more serious about its investment. It's almost like America kind of under this Trump regime have suddenly woken up and then making these token gestures because of the news. It's almost like, you see, we're now starting to act too. But the amounts are trivial. I think America mentioned 12 billion. China has been doing for multiple years, decades, substantial investments and growing soft power where it is not so offensive, but they are actually real movers and shakers in Africa.
The real story here isn't silver. Is capital allocation discipline between superpowers. Francis Hunt is pointing to a scale imbalance. $500 billion versus $12 billion isn't competition, it's strategy versus reaction. China's infrastructure spending across energy and minerals mirrors how the US built oil dominance in the mid-20th century. Since 2013, China's Belt and Road linked resource investments have exceeded $1 trillion globally, quietly locking supply chains. Francis Hunt is essentially highlighting a commodity security race investors rarely price into mining equities or industrial metals. Next, the supply chain chessboard becomes even more important for metals pricing.
And in all sorts of areas without being overly bombastic and domineering and working with existing governments. So in some senses, they've been smart. They've been slowly catch the monkey in that sense, in terms of how they've gone about ensuring supply. And of course, in the Middle East and various other places where they've been cooperative, good partners, whilst America seems to have lurched into suddenly waking up and actually doesn't have the means in truth to do it on the full scale that China has been accumulatively doing for an extended period. I mean, we all speculate on how much gold China truly has, but I can tell you all black gold that is being subsistence mined ends up via Saudi, UAE into Hong Kong and Shanghai. As someone who's living in Africa, there's a permanent bid on that and the refining process and taking it. That's not what's being bought officially declared through futures for delivery where you can track and all of this. This is even on the what I'd call the dark metals level. Mm-hmm. They've been stacking and they must have an absolute fortune.
Commodity markets often move long before official reserve numbers confirm the shift. Francis Hunt suggests unofficial gold flows may matter more than reported central bank purchases, which reached about 1,037 tons globally in 2023. If physical metal is being accumulated outside futures markets, price discovery may be less transparent than investors assume. Africa and Middle East refining corridors have become strategic logistics hubs, not just commodity exporters. Francis Hunt is highlighting how off-balance sheet accumulation can reshape currency confidence faster than public reserve disclosures. Next, the conversation shifts from accumulation to monetary strategy itself.
And they've set about using gold as a trade-based vaulting system for their trade system. So they're going to establish vaults for counterbalancing. So they're going to go to a backed currency. it's not about the yuan, it's backed by gold. People really don't care what the piece of paper says if it's backed by gold. It can have a Chinese face on it. If it's backed by gold, it'll be worth more than, Abraham Lincoln or Benjamin Franklin or anybody else, which isn't. So they're winning in terms of the long game. And the hegemon has an uneasy role, and this has death of vampire vibes to it, and that's what Ray Dalio, who you also mentioned, has been warning of. The fullness, though, is that the debasement in dollar is going to cause rampant inflation. We called the labor lies during the Biden administration, and that's largely been accepted now. Millions have been stripped out. There was a lot going on in terms of government hires for various agendas that are BlackRock related. You name it, they did it.
Reserve currency transitions rarely happen suddenly. They erode through trust first. Francis Hunt is echoing Ray Dalio's long-cycle debt thesis, where excessive borrowing weakens monetary credibility over decades, not months. The US debt to GDP ratio now exceeds 120%, a level historically associated with currency pressure in major economies. Even without a gold-backed currency launch, incremental settlement systems using bullion could shift trade psychology. Francis Hunt is emphasizing that credibility, not currency branding, determines monetary leadership in global markets. Next, the dollar's performance tells a more complicated story than headlines suggest.
And these were sold. Oh, but it's a red-hot economy. We didn't have, we didn't have a recession. It's a red-hot economy. So that's been shown to be a lie. Now with this relative underperformance of the dollar, don't forget it lost 10, 11% to the euro. It was down about 15% to the Hungarian florins and 40% to the ruble, by the way, who's supposed to be a sanctioned nation, who seems to be doing extraordinarily well, selling their oil via intermediaries or taking a cut. You're still probably getting it. The only beneficiary is Europe, who's paying much more for their energy and is therefore no longer making the profits they made for the pipeline being shot and everything else. So the whole grand game is going ahead. Your question was also about copper. And the one thing I'll say is all commodities will go up, but your monetary metals, because this is a fiat and debt debasement crisis, the biggest winners are the monetary metals in that. So many people want to sprawl out of gold into other things because they're going up. And I always say, yes, copper is going up, and I will show that chart to you.
Currency performance often reveals stress before equity markets do. Francis Hunt points to relative dollar weakness. And historically, commodity cycles tend to strengthen when the dollar index declines more than 8 to 10% year over year. Energy trade flows since 2022 sanctions have also reshaped pricing routes, especially through intermediary markets. While copper tracks industrial demand, monetary metals often outperform during debt expansion cycles, like the post-2020 liquidity surge. Francis Hunt is distinguishing cyclical commodity rallies from structural monetary hedging behavior investors often confuse. Next, the conversation turns toward measuring assets against gold instead of dollars.
Well, look what's happening here on the gold-silver ratio. We were talking about the gold had that shooting star, and that's actually a very bearish candle, especially on a weekly time frame. That's quite a long one. You had that shooting star, and then I said, one of the only real ways that you can put it back into bed and go back into the reflation and upside is if you have a hammer to the downside of equal scale. Then you continue back up. In other words, you had a blow off, you had a collapse, you had an overshoot to the downside. Now you're bouncing back, you negate that. Well, you've had very similar here. You've got a very strong hammer, which is actually bearish for precious metals. The gold-silver ratio going up. It's actually generally bearish. It doesn't have to be hugely bearish. Gold can sometimes go up in that environment and silver can be flat or mildly down. But what we're now getting in terms of this month is you've had a reversal on the follow through here, and it looks like this green candle is coming back down. This green body may end for the month, and bear in mind we're only the 10th.
Technical reversals often appear before narrative shifts in financial media. Francis Hunt is focusing on the gold-silver ratio, historically a key signal of precious metal cycle transitions. The ratio spiked above 120 during the March 2020 liquidity crisis, before silver dramatically outperformed gold afterward. When the ratio declines, it often signals improving risk appetite within the metals complex. Francis Hunt is emphasizing patience. Monthly candles matter more than daily volatility for macro investors positioning portfolios. Next, the reflation thesis for precious metals begins to take shape again.
So again, I'm calling early, but you're probably going to have a reversal, having run up to back into the 70s. And we expected this because you ran the key level of 50 on the gold-silver ratio. You ran it to the downsides, you got a snapback rally, you ran all the way back into the 70s, and now you're coming slowly with your way back down. So this is just a period of volatility, a little bit blow-offy. I'll move it on to the weekly time frame, because when I showed you those shooting stars, it was actually on weekly. So you had quite a big surge up, but then you see this wick has come a long way down, and actually you're trading red here. So I think the reflation of precious metals post a little bit of a slap in the face for doing too much too soon is very much back on the card. So dip buying is part and parcel of this. Please bear in mind, this is not the same as my leverage trading that I'm sometimes talking about on YouTube, and that we update our community on, which has been very profitable. So as an investor and a stacker, we say keep stacking. There's no way you're anywhere near the highs at this juncture.
Volatility often looks like failure right before a trend quietly resumes. As Francis Hunt suggests, the gold-silver ratio moving from 50 back toward the 70s signals repositioning, not collapse, especially after metals rallied aggressively into January. Historically, after sharp commodity surges, consolidation periods can last several weeks, while institutional money rotates back in, similar to gold's behavior after the August 2020 spike. Investors should remember the difference between leveraged trades and long-term allocation decisions, particularly with inflation expectations still above 2.5% globally. And as Francis Hunt hints next, the ratio itself may reveal where capital flows are heading.